So how to place an IRON Condor trade with Questrade. So first of all, you can only place an IRON Condor trade in a non-registered account. So you can't use a TFSA or RSP. It has to be a margin account. And not only that, but you need to, with Questrade, you need to register with level 2 or level 3 options, I believe. So to actually register for a different level of options trading, you simply go to your accounts, then you go to account management, and then you pick your account, so margin account. So obviously, first of all, you need to have a margin account. Then as you can see here, option level 3, if you need to change it, you click on change, and it actually tells you, and then you choose your account, margin account, and as you can see over here, I'm already at level 3. So it tells you here, level 3 minimum balance required is 5,000. With level 3, you can place long or short vertical calls or puts. So basically, an IRON Condor is a combination of vertical calls or puts, a short vertical calls or puts, and it's also, you could see here, long or short condors, long or short iron butterflies, or IRON Condor. So it's over here. So you can see it has to be level 3. You need to have level 3 option trading in Questrade to trade IRON Condors. And there's a note here, you cannot trade any level 3 option strategies in registered accounts. So regardless of your broker, you need a margin account in order to trade IRON Condors. If you look at level 2, you could write covered calls with level 2, but you can't do IRON Condors. All right, so to place an IRON Condor trade with Questrade, simply look up the stock or the ETF that you want to trade. So for example, if we look at Tesla, because it took a big drop recently, and then you look it up under the options tab, and then where you see call and puts, you choose IRON Condor, and then you choose the expiry date. So let's say you go, ideally you should go 45 days out, but let's say you go 30 days out, let's say to July 19, let's say. Simply click anywhere, click buy and sell. Your order entry window populates, and then over here you're going to choose the strike prices that you think the stock will trade between now and expiry date, or will not surpass come expiry date. So for example, Tesla's trading at 215 right now. So on the call side, let's say I think that it's not going to surpass 280, so I can click, so I'm going to sell the 280 call option. But for protection, in case it does go over 280, I need to buy a call option for protection, so I'm going to buy the 285. Because normally when you sell something, you need to buy it back. So if you sell something at $1, for you to win, when you sell a call option for $1, the stock needs to stay below that strike price for you to win. If it goes over, you need to buy it back. But if you don't have protection, your risk is unlimited, because you could end up buying it back at $5 or $10, depending on how high Tesla goes. So for protection, when you buy a call option at 285, you're limiting your loss at the difference between the two strikes. So 285 minus 280. So your max loss is $5 on this trade when you buy the call option. And let's say for on the put side, so I think Tesla is not going to drop below a certain price by expiry date. So let's say 165, and I'm going to buy the same thing. I'm going to buy protection in case it does drop below 165. I don't want my risk to be unlimited, so I'm capping my loss potential, which is going to be only $5. So it's the same risk whether Tesla goes way up or whether Tesla goes way down. I have the same risk of $5. So now I'm going to use something called delta, which gives me the probability that this stock will go above these strike prices. So leg 2, which is the one I'm selling on the call option, it says 3.5. So it's about a 3.5% chance that Tesla will be above $280 come expiry date. So I can go, I'd rather take a 5 delta. That's usually the safest. So if I go with a 275, and then I can adjust my protection to 280 to keep the difference only 5. So now I've got a 4 delta, as you can see on the call side. So that's fine. I'll keep that. And then on the put side, as you can see, I have a 2 delta, so I can come a little closer. So let's say 175. That gives me a 6 delta. Yeah, okay. So let's leave it at 175, and then for protection 170. So yeah. So basically, I'm saying, basically, I only make money on this trade if Tesla stays between 275 and 175 come the expiry date of July 19. Right now it's trading at 215. So I'm giving myself a very good chance. basically it's a 90% probability of profit, because I've got 5% chance that it goes out on the call side and 5% chance that it goes out on the put side. So that means I'm left with 90% chance of being right. It's a high probability trade, and in return what I can get is basically I can get the difference here. I'm going to collect $3.78, pay $3.10, collect $1.28, pay $1.15. So I'd collect around 81 cents or $81 if it's one contract. So I'd collect $81 with this trade. I'd collect it up front by selling it, and I keep all the $81 by expiry date if Tesla stays between 175 and 275. Also, at any point, because options lose value when they come closer to the expiry date, the 81 cents I collected, I can actually just buy it back for less, for example, for 40 cents or 30 cents if Tesla doesn't move much and we're getting closer to the expiry date. So at any time I can close the trade early, or I can let it wait till expiry date. It'll depend on the movement of Tesla. So my max profit is $81, but I can always close it out early and make a little bit less. But my max loss is $5, which is the difference between the two strikes, minus the $81 I already collected. So that's my max loss. It's a big amount, but it has a small chance of happening. So my max loss is about $419. But I could actually decrease my max loss throughout the trade by making adjustments. So for example, if Tesla is going up and it's getting closer to my 275 strike, well, I can close the put side of the trade. I can close it out and actually sell another one a little bit closer. So I can close this 170, 175 put spread and maybe sell a 210, 215 put spread in the case where Tesla is getting closer to 275. So I'll collect a small credit, which reduces my max loss. It also reduces my probability of profit because I have a smaller range. But in case Tesla does go above 275, well, then I collected an extra credit, so it reduces my max loss. Instead of losing $419, I'll probably lose, let's say, $380. But in general, you don't want to make adjustments. If you pick the right ranges from the beginning, you increase your chances of success. But of course, anything can happen. So you need to be proactive in case you need to make adjustments because the stock moved against you. But this is how you would place an IRON Condor trade. And then you simply click send order. And as you can see, it's a credit. You're collecting 81 upfront. If you have active trader pricing, it's going to cost you $5 plus 75 cents a leg. So 75 cents times 4 plus $5. So it's going to cost you $7.96. You're collecting 81 and your max loss is 426 here. The change in maintenance excess is your max loss. So this trade doesn't actually use margin, it uses actual cash. So there's no interest charge, and you're collecting, the trade is a credit up front. You could, as you can see, it's buy to open, sell to open, buy to open, sell to open. So you're selling these put options, but you're also buying these put and call options as protection. So I've come to realize that the only way these trades work is if you place a lot of them, because it's a probability play. So as you can see, I have a 90% chance to make $81, so that's $72. But I also have a 10% chance of losing $420, which is $42. The more I place these trades, given these same amounts, the more the probabilities play out, and I'll be making a $30 profit. But for example, if I were to only collect $50 on this trade, so if I went with a trade that gives me 90% profit, probability of profit, but I'm only collecting $50 credit, that means my max loss is $450. So I've got a 90% chance of making $50, but I also have a 10% chance of losing $450. So that's minus 45. So in the long run, the more I place these trades, I'm just gonna break even. It's like flipping a coin. If you flip a coin 1,000 times, odds are you're gonna get half of them heads and half of them tail, or very close to half. But if you flip it only 5 times, you might get 4 heads and 1 tail. It's just because the 5 first times it could go either way. But the more you play it, the more the probabilities will get applied. So you really need to look at the deltas before going into a trade to know what your probabilities are. You need to place a lot of them, and before getting into the trade, the credit received needs to make sense. Now, the way I was placing them before is I would look at a stock and I would just make an assumption. I don't think it's going to trade outside this range, so I'm going to pick this range just like that without looking at the probabilities. Sometimes I'd be right. Like I think out of maybe 10 trades I placed, I was probably right 6 times. But there's 4 times where it just went against me. I was greedy. I had the chance to close the trade early, but I didn't. And what ended up happening is I lost very close to the max loss of like over $400 or $500 for these trades. So the 4 trades that I lost $500 in completely erased the 6 trades that I made a profit of between $50 and $150. So if we look at the SPY, which is an ETF that tracks the S&P 500, this is probably the safest thing you could trade. You won't make as much money, but it's the safest because it doesn't move much like an individual stock. And let's say we go July 17. So if we want a 90% probability of profit, on the call side, we're probably going to have to go all the way out to, let's say, 305. Let's see what that gives us. So it gives us 6%. Okay, that's fine. So for protection, we're going to buy the 310. And then on the put side, probably we're going to have to go to 275, let's say. Let's see what that gives us. 6% as well. Okay, that's fine. And then for protection, we're going to buy the 270. So we've got on the call side, we're selling the 305, we're buying the 310. And on the put side, we're selling the 275, buying the 270 for protection. It's going to give us about a 90% probability of profit. But here's what you would collect. So on the put side, you'd collect about $50. And on the call side, well, because market is closed right now, there's no activity on this. But it's probably going to be around 10 or 12 cents. So on this trade, you'd collect about 147 minus 93 plus 12. So about $66. But you're risking, since your strikes are $5 wide, you're risking $500 minus the credit that you receive. So you've got a 90% chance of making $66, but you've got a 10% chance of losing the difference, which is $434. So in the long run, the more you place these trades, you're going to end up only making $16 per trade, which if you compare to your capital that you placed on these trades, which is about $434, because that's what you're risking, right? Going into this trade, that's about 3.6%. So that's like making 3.6% per month in the long run. Times 12, that's about 44% per year. Now I've got some IRON CONDOR trades on the S&P 500. I've got one on the SPX, which expires next week. And I've got 2 on the SPYs, which are the ETFs. So the one on July 12, expiring July 12, this one, I think I collected about $54 on this one, risking obviously the difference of $500 minus $54. But as you can see, this one right now, the deltas are still fine. I'm still in a decent range in terms of the delta, in terms of the probability of profit. If I look at the other one, expiring July 5th, I'm in a little bit of trouble because, as you can see, the delta went up to 32%. So the trade started off at 5%, but now it went all the way up to 32 because my strike was 293 and it's trading at 289. So it's getting very close to my call side. So now I might have to make an adjustment, although it expires July 5th. So about 3 weeks left. So the adjustment that I could make is maybe roll up the put side. So my put side is at 276. Maybe I could bring it up to 280. So it's still far from 289, but higher than the 276 so that it allows me to collect an extra credit just to decrease my max loss in case the SPY does go above 293 come expiry date. So, or another thing I could do is probably just close this trade completely. But of course, I would lose money closing it. But I'd be losing much less than if I waited till expiry date and allowed it to lose the max, which is about $430. So I could either keep moving the untested side for a credit and keep reducing my max loss, or I could just close it early and then place another one with the same expiry date, but with a tighter range, so that the whole adjustment can be made for a credit, and just hope that come expiry date the SPY falls in the range in the new range that I chose. So that's what I've been doing with the SPX, because this one has definitely tested my call side. So my call side was at 2,890, and it's trading at 2,886. So it's very, very close. My initial trade on this was actually had a strike of 3,000 on the call side, but when the markets dropped in May and it went all the way down to 2,700, I decided to bring my 3,000 call closer. I brought it all the way down to 2,890. But now the markets are going back up, so now my call is getting tested. So that's one of the issues with making adjustments, is you might make adjustments early and then the stock goes back the other direction. So then you're getting tested on the call side when you weren't tested in the first place. So definitely these IRON Condor trades require more time, it consumes more time, you have to keep watching. It requires more management for sure, but it does have its advantages, which are you could trade anything. You don't necessarily have to guess the direction of the stock, you just need to guess the range, and the return on capital is much higher than anything else. And you know the probabilities of being right or wrong, and you could use that to your advantage, but you do have to place a lot of trades so that your probabilities get applied. You have to place small but many trades, so it definitely takes a lot of time and a lot of effort and a lot of commissions, of course. So yeah, so basically this is how you would place an IRON Condor trade with Questrade. So if you have any questions, leave them in the comments section below, and don't forget to check out the links in the description below. Thanks for watching.